Thank you very much, Russ, and thank you all for inviting me to here to speak to you today. It's always a pleasure to be in Halifax, especially on such a perfect, sparkly October day like this one. So in my remarks today, I want to take you inside the Bank of Canada, and I'd like to walk you through our monetary policy decision-making process. And in particular, what I want to do is I want to focus on how we account for the dimension of time. So let's start with a very basic reality. All Canadians make choices in the present that we know will have consequences far into the future. Anyone who makes a decision on whether to take a job, whether to pursue higher education, to buy a house, or save for retirement, has to have a view of what the results will be at some point in the future. Businesses deciding whether to hire more workers, whether to expand their plant and equipment, seek new customers, adjust their prices, or finance their operations, are also facing a similar reality. And as CFAs, those of you who are CFAs in the room, you know that time is at the center of every financial decision that you either make or advise on. The Bank of Canada's mandate, which is to deliver low, stable, and predictable inflation, is fundamentally rooted in the importance of time. Our job is to make sure that those longer-term decisions that Canadians are making are not wrong-sided by unexpected changes to the value of money. The confidence Canadians have in their money can't be taken for granted. It's something we work hard to achieve and to maintain. Second aspect of time, though, in that is that for the Bank of Canada, it's also true that our short-term decisions have longer-term results. To achieve a good inflation outcome, we need to make policy decisions about our policy interest rate in the short run, meaning every 6 weeks. These decisions, in turn, influence how the economy and inflation will behave over a much longer period of time. Now, as you know, 6 weeks can be a long time in the markets and for the economy, and we approach each decision that we take every 6 weeks with a vast set of new information. And to start with, inflation itself can fluctuate, both for fundamental reasons and as a result of various temporary factors. In addition, we receive all kinds of other economic data and lots of financial market and commodity price data as well. And we receive many relevant news items about economic policies here and elsewhere, about foreign conflicts and even the weather. So how do we react to all that information? I mean, how do we react without overreacting and basically keep our eyes on the prize? Now, I hope you won't be disappointed that I'm not going to tell you what we're going to do next. Now, to tell you the truth, I don't actually know, because, as I said, a lot can happen in 6 weeks. A lot can happen between now and our next policy announcement, which is on December 2nd. But what I will do is to spell out the logic of our approach, how we think about the underlying trend in inflation, and how we make sense of the stream of information that's coming in. So let's start with some background on our inflation targeting framework. Now, Canada's decision in 1991 to set a target for inflation did not come out of the blue. It was a product of 2 decades of unacceptably high and variable inflation. During the 1970s and 1980s, which I know many of you are too young to remember, but I'm not, inflation became part of everyone's calculations. Adjustments for inflation were a contentious element in wage negotiations. Interest rates rose into high double digits, building in a premium for the high expected rate of inflation and also for the uncertainty around it. High and variable inflation also had very different effects on different groups. Some saw their salaries, savings, and pensions eroded away, while others reaped windfalls on their houses and their financial investments. For most of that period, Canada's monetary policy struggled to find a clear direction. Half a century ago, monetary policy was anchored by the Bretton Woods system of fixed exchange rates, but that system collapsed in the early 1970s in the face of increasingly open capital markets and contradictory policies in the United States and other major economies. In the mid-1970s, Canada, like many other advanced economies, tried targeting the rate of growth of the money supply. This approach was based on extensive research, which demonstrated that inflation tended to be associated with increases in the supply of money in the economy. But with deregulation and financial innovation, the relationship between the rate of expansion of the money supply and the rate of inflation turned out to be unstable. Money supply targets were no longer viable, and in Canada they were abandoned in 1982. Before and after that money targeting period, the Bank of Canada had no clear policy framework to guide monetary policy actions, nor to anchor the public's expectations of inflation. Inflation rose higher as monetary policy in effect accommodated the inflationary pressures coming from commodity prices, fiscal deficits, and from higher inflation in other countries. While inflation was eventually tamed during the 1980s, that was a long and arduous process, which came at the cost of several years of subpar economic growth. Then, in 1991, recognizing the importance of inflation to the economic and financial well-being of Canadians, and the central role of monetary policy in controlling inflation in the longer run, the bank began pursuing an explicit target for inflation. The results have been impressive. Since 1991, inflation in Canada, as measured by the Consumer Price Index, has been remarkably stable. Inflation has averaged almost exactly 2%, and its variability has fallen by roughly 2/3. Canadians have benefited in a number of important ways, which are sort of the flip side of the costs of inflation I talked about earlier. Greater price stability has allowed consumers and businesses to manage their affairs with greater certainty about the future purchasing power of their incomes and of their financial assets. Real and nominal interest rates have also been lower across a range of maturities. More broadly, low, stable, and predictable inflation has facilitated more stable economic growth in Canada and lower and less variable unemployment. Our inflation targeting regime also stood the test of the 2007-09 global financial crisis. As the fallout from that crisis was hitting the Canadian economy, the Bank of Canada responded. We eased monetary policy aggressively to forestall a deeper and more prolonged economic slump. Inflation targeting gave us the flexibility to allow that strong policy response. It provided an analytical framework for calibrating how far we should go and for how long. It also anchored the public's confidence that despite the extreme conditions of that period, policies would remain on track to achieve the 2% inflation target. A particularly useful feature of our inflation targeting framework is that every 5 years we renew our agreement with the federal government. That agreement sets the target for inflation and the parameters for achieving it. And the renewal process provides both the opportunity and the discipline to reassess our approach in a systematic way and to look for any room that there might be for improvement. But the bar for any major change is very high. We know that inflation targeting has turned out to be far superior to any other framework that has been tried so far. Also, as I have stressed, part of the purpose of a monetary policy framework is to allow Canadians to make longer-term decisions without having to worry much about inflation. And that argues against changing our framework unless it's really necessary. Let's now look at time and the way in which it enters into how we target inflation. Targeting inflation involves important challenges because we don't control inflation directly. Normally, we influence inflation through our policy interest rate, more precisely, a target for the overnight interbank rate of interest. Our policy rate affects other interest rates in the economy, overall financial conditions, and in turn, the economy at large. It affects inflation through the amount of excess supply and demand that exist in the economy, or the output gap as we call it, which can generate pressures for either inflation or for disinflation. The exchange rate and expectations can also play important roles in transmitting the effects of monetary policy to inflation. Because of the nature of this process, there can be long lags in the transmission of monetary policy, and these lags can also vary significantly depending on the economic context. Total inflation can also be noisy because many temporary sector-specific factors impinge on inflation in the short run and in many cases are quickly reversed. Some examples are consumer energy prices, such as gasoline prices or heating oil, or prices of certain food products that may fluctuate because of weather and other factors. In this setting, we can't hit our inflation target precisely or continuously, and we don't try to. To illustrate, consider what would happen if we did try. For example, if we raised our policy rate mechanically whenever inflation was above target and lowered it whenever inflation was below target. We would end up reacting to a lot of temporary factors. And because our policies work with long lags, we would have to overreact, making huge adjustments to our policy rate in order to have any effect immediately, followed by huge corrections in the other direction to compensate for the lagged effects of our own policies. This would lead to what has been called instrument instability, which is a kind of policy oversteering which would quickly land us in the ditch. This reasoning points us in two directions. First, we need to be able to look through the temporary factors that affect inflation in the short run, so that we don't overreact to shocks that are going to reverse themselves anyway. Second, we need to understand and anticipate the forces that will affect inflation in the future so that our policy decisions will keep inflation on target until their effects have worked their way through the economy. Both of these elements go into making a judgment on the underlying rate of inflation and how it is evolving. So rather than trying to hit the inflation target continuously, we set a time horizon for reaching it. Normally that horizon is 2 years, which is based on estimates of what a reasonable time frame for policies to have their effects and for temporary shocks to dissipate. But we have the flexibility either to return sooner or to take longer, depending on the nature of the shocks affecting the economy. In particular, under flexible inflation targeting, we have the scope to take longer to get back to target in a situation where returning to target within 2 years would require aggressive policies that could result in a buildup of imbalances in our financial system and possible instability down the road. This point was made explicit in our inflation targeting framework the last time we renewed it in 2011. The timing for a return to target thus requires a judgment on the balance of risks. Even when inflation is at target, we can't afford to be complacent. Sometimes there are forces pushing inflation higher or lower, and we need to use monetary policy to counteract them. In such cases, the policy rate will need to deviate from its long-run level in order to provide the stimulus or restraint necessary to offset these other forces. There are also some situations in which we need to get ahead of shocks that we can see will have a significant effect on inflation. Otherwise, we'd be in a situation of trying to catch up with those effects even after they have already become entrenched in the economy. That was a major part of the logic of our January 2015 rate cut. We could see that a 60% drop in the price of oil would, on balance, be bad for the Canadian economy. So even though it was still uncertain how large and how prolonged that effect would be, we needed to act promptly to achieve our inflation target. The combination of long and short-run factors affecting inflation, the lags and the effects of our policies, and the uncertainties around each element makes monetary policy fundamentally an exercise in risk management. Inflation targeting is also informationally inclusive, as it's been called, meaning it doesn't just react to the current inflation rate and GDP. It also takes account of a broad range of other information. That includes economic and financial data, as well as soft information, such as the responses to our Business Outlook survey, and a wide range of more informal conversations that we conduct with business people and with other Canadians. We use a combination of models and our own judgment to understand the underlying forces that are working on inflation. We want to get as clear a picture as possible, not only of what is actually going on, but of what could go wrong if the unexpected happened. In thinking about targeting inflation over time, underlying inflation is an aspect that has received a lot of attention recently. When we talk about underlying inflation, we mean the inflation rate that would prevail in the absence of various sector-specific and one-off factors that can affect the measured CPI from month to month. Conceptually, underlying inflation should be driven mainly by the amount of excess supply or demand in the economy, together with the public's expectations of inflation. Now, underlying inflation has been a particularly salient concept this year. We have the impact of the oil price shock, which is pushing inflation down via the prices of gasoline and other consumer energy products. At the same time, the weaker Canadian dollar, which is largely associated with the lower price of oil and other Canadian commodity exports, has been pushing measured inflation upwards. There are also a number of one-off factors that have also been affecting inflation. So our challenge is how to distinguish the trend from the temporary to avoid overreacting to the temporary, as I've been mentioning, and to give the public confidence that inflation will return to the right track. For this reason, the Bank of Canada, like many other central banks, uses a number of measures to calculate what's called core inflation, which are designed to minimize the influence of transitory price movements. We've identified 4 key properties that an effective core measure must have. First, it must be less volatile than total inflation. Second, it must closely track long-run movements in the total CPI. In other words, it has to be unbiased. Third, it must be related to the underlying drivers of inflation, notably the output gap. And fourth, it must be easy to understand and explain to the public. Since 2001, the Bank of Canada has featured one measure of core inflation as our operational guide to policy, CPIX, which excludes 8 of the most volatile components of the CPI and adjusts the remaining components for the effects of indirect taxes. Another exclusion-based core measure, CPIX FET, takes out food, energy, and indirect taxes. Yet other measures calculate core inflation using a trimmed mean, which excludes different components each month based on whether or not they are exhibiting volatility at that specific point in time. More sophisticated measures track common price movements across categories in the CPI basket. Such movements are more likely to reflect aggregate demand fluctuations than sector-specific developments. The advantage of these latter tools is that they take information on all the prices in the CPI and use objective methods to filter that information. The disadvantage of this approach is that in some cases, these measures are constructed using techniques that, while firmly founded in logic and statistical theory, are quite opaque to the outside user. All these measures have followed similar tracks, however. Each measure satisfies the key properties identified above, but to differing degrees. They all display less volatility than total inflation, and all but one track long-run movements in the CPI very closely. While the various measures are correlated with the output gap to differing degrees, they all have some predictive power for total inflation. But no formula can completely exclude idiosyncratic factors. We've had some examples of those lately, that is, of idiosyncratic factors that are part of our core measure of inflation, which include automobile pricing, telecoms, consumer electricity, and natural gas. These products that are subject to idiosyncratic factors can change from period to period. Obviously, we can't change our measure each time that happens. As we prepare for the renewal of our inflation control agreement with the federal government next year, we are examining the properties of these measures of core inflation to determine whether the bank should continue the practice of identifying one preeminent measure as its operational guide, and if so, whether CPIX is the measure that should continue to play that role. Today, we published on our website our latest technical assessment of these various measures of core inflation. I now want to go on to discuss one factor that can have a particularly important effect on inflation, that is the exchange rate. Inflation targeting can only work with a flexible exchange rate, which gives the Bank of Canada room to set monetary policy independently of other countries. We don't target the exchange rate or even publish a forecast. With a floating exchange rate, the external value of the Canadian dollar can change for a variety of reasons, and that affects inflation in Canada through 2 channels. It has a direct so-called pass-through effect on the price of imported goods. The exchange rate also affects inflation more indirectly through its impact on aggregate demand in the Canadian economy, mainly through its effect on the competitiveness of Canadian-produced goods and services relative to those produced elsewhere. The pass-through effects are transitory, while the effects on aggregate demand will generally persist over a longer period. The importance of both of these kinds of effects is particularly evident when the change in the exchange rate is as large as it has been recently. In less than 2 years, the Canadian dollar has lost more than 20% in value against the US dollar. The effect of this depreciation on exports and the real economy is already evident. It has improved the competitiveness of many Canadian producers. Export categories that historically have been sensitive to exchange rate movements are showing stronger activity. Examples include building and packaging material, furniture and fixtures, clothing and textile products, and large motor vehicles such as heavy trucks and buses. Exports of services, which constitute about 15% of total exports, are also benefiting, and tourism, of course, is a rather prominent example of that. The pass-through effects are also quite significant. They are estimated to be adding about a percentage point to total CPI inflation. So how does monetary policy react? If the change in the exchange rate is seen as a temporary factor, reflecting other structural changes, it is clearly appropriate to look through the pass-through effects in assessing underlying inflation and in making monetary policy. That, in our judgment, is the case at the present time. The depreciation of the Canadian dollar is driven mainly by two factors. First, it is associated with a sharp decline in Canada's terms of trade as the prices of oil and other Canadian commodity exports have decreased. These commodity price developments are, in turn, the result of the dynamics of supply and demand for those commodities in a global market, certainly not a result of Canadian monetary policy. Second, the depreciation of the Canadian dollar is part of the general strengthening of the US dollar as that economy strengthens and as the Federal Reserve moves closer to normalizing its monetary policy. By that logic, we exclude the direct impact of the pass-through effect of the exchange rate movement in assessing underlying inflation. Therefore, we judge that underlying inflation in Canada is currently running at about 1.5 to 1.7%. Of course, the effect of the weaker Canadian dollar in stimulating the Canadian economy is an essential ingredient to our projection that underlying inflation will return sustainably to target with the economy back to its potential over the next couple of years. Let me wrap up. Our inflation targeting framework has stood the test of time. It has proved vastly superior to any other policy alternatives that have been tried. Our periodic renewals are important opportunities to make sure that it continues to serve its purpose and to suggest improvements. Today, I've focused on one set of improvements that we're considering, how we assess the underlying trend in inflation, separating it from price movements that are likely to be temporary. The critical test is the confidence you have that inflation will remain within our target range. We would like the public to take 2% inflation for granted. We don't, however, take your confidence in us for granted. We know we have to earn your trust by delivering, without fail, on that commitment.
We have time for a few questions. If anybody has questions, can you raise your hand and we'll have somebody pick them up? I may have a couple of questions.
Okay.
Just as we wait for them to get up here. When Canadian labour force growth slows to zero towards the end of the next decade, assuming no significant improvement in productivity, is it conceivable that the neutral policy rate for the bank could still be around 2% or possibly lower?
Well, yeah, that's a very important consideration in our monetary policy, and I mean, just to sort of join up the dots in the question, I mean, basically, you know, a year or so ago, we published a reassessment of our neutral rate, which is kind of the rate that our monetary policy rate is likely to converge to when the various shocks and external headwinds have dissipated. Over probably the horizon of a couple of years' time, and that's a measure that depends on a number of structural factors, but particularly it depends on the rate of potential growth in the economy. So we basically what we've seen is that the slowing of the Canadian labour force has resulted in a lower rate of potential growth in Canada, but it's also resulted in a lower a lower neutral rate of interest, and so that we'd expect that in general the level of interest rates would be lower than it had been in the past. So as that trend continues, if it continues as expected, then we'd see neutral rates more or less in the range that we talked about, which would be in the sort of which would be a bit higher than the number you mentioned, but we're still looking at we're still of course updating those numbers as time goes on.
One of the questions we have: exports have been slow to react to the recent Canadian dollar depreciation. Can you say why?
Well, I mean, there are always time lags involved. I mean, I think the experience with Canadian exports over the last couple of years has been actually a series of disappointments, in the sense that Canadian exports have responded less strongly to the pickup in demand in the United States than would normally be expected based on sort of the historical relationships among those variables. What we've seen more recently is that we've actually seen a pickup in Canadian exports, particularly in categories that are sensitive to exports. But I think one of the challenges that Canadian exporters have faced is that because we've come out of a period of a very strong Canadian dollar, and that's led to the disappearance of a number of companies that were exporting. As a result, even though the demand has picked up and they've now been in a position that they can compete on better terms because of what's happened to the Canadian dollar, at the same time it's taken time for not just for them to ramp up their production to take advantage of the opportunities, but in some cases may actually require new firms to come into existence to take advantage of those opportunities.
Okay, when assessing inflation, what does the Bank of Canada estimate the natural rate of unemployment to be?
We don't actually publish a measure of the natural rate of unemployment, but we do look at, and in fact, maybe I should emphasize, we look at a broader measure of labor market conditions. I mean, the unemployment rate is obviously one measure, and that's been coming down on the whole over the last few years, but it's fairly gradual improvement. But the other thing is, of course, there are other aspects of labor market conditions that have been away from their normal state, and that would include the fact we've had a lot more long-term unemployment than is typical. We've had more involuntary part-time work. We've had depressed labor force participation by some of the key age groups, and so all those things have been showing a gradual improvement over time, but we're still not back to normal yet.
On productivity, when the Canadian dollar was high, Canadian manufacturers were reluctant to invest. Now the dollar is lower. Where do you think the Canadian manufacturers are going to be going forward?
Well, certainly productivity in Canada is a topic on which I think many thousand gallons of ink have been spilled, and I mean, it is a very puzzling question. I think really what accounts for Canada's weak productivity performance relative to the United States in particular. I mean, there are a number of factors obviously that enter into that, and some of it is probably the scale of our firms. Some of it is the demographics, the sort of dynamics of firm creation in Canada and the way the financial system either supports that or doesn't support it as well as it could. And so there may be a number of ingredients, but over time we'd expect that productivity would pick up, but it is something that generally would take time to respond. And in particular, I think what we've had is a period of relatively slow growth during which I think firms have been reluctant to make the investments needed to boost their productivity because they haven't been confident that the demand will be there when they finish the improvements. And so I think as confidence builds, then we should see some of those steps being taken and probably improvements in productivity reflecting that.
You actually answered part of this next question to some extent, but with the expected expansion of QE in the ECB, what effect do you think it'll have on the Canadian exchange rate and our inflation rate?
Well, certainly that's been a factor this year, affecting both the level of interest rates in global financial markets and therefore in Canada, but also affecting the structure of affecting exchange rates. I mean, the European or the euro area's exchange rate has been depreciating along with the Canadian dollar vis-a-vis the U.S. dollar in this period of time, and continued QE is certainly a factor underpinning that. I mean, QE is something that works through a variety of channels. I mean, like any other monetary policy, it works through a combination of effect on overall financial conditions, but also to some extent via its effect on the exchange rate. And I think we've seen that also in the case of the European central banks' policies.
Since 1991, the bank has had a bidirectional lever to target inflation. Now with a unidirectional lever, as rates approach zero, does that concern the bank? And is there an alternative level beyond overnight rates? Well, yeah, I mean, certainly we know a lot more about levers of monetary policy under exceptional circumstances than we did 7 years ago. Fortunately, in Canada, as far as we got was to get our rates down to 0.25% and to lay out what we thought we could do if we had to do more. But fortunately, at that time, the Canadian economy actually didn't need more monetary policy stimulus, and so we didn't actually have to do more. But of course, in the last 7 years, we've seen central banks in quite a number of countries implement a number of unconventional policies, including QE, but also various credit market measures, negative interest rates in some countries, and various other steps. And so certainly we've been looking at that whole experience analytically. We've been considering what the options would be, but obviously our current baseline is that current level of monetary policy stimulus is appropriate, and we don't see a need to provide further monetary policy support at this time. How much volatility does the low industry diversification of the Canadian economy contribute to CPIX?
Well, the CPIX doesn't, it's not affected so much by industry diversification because CPIX measures prices from the point of view of the household, so that it's really a basket of goods consumed by a typical Canadian household. Obviously, that's an average, so it's not the right basket for every household in Canada. But broadly, it depends more on how households allocate their spending than how the economy, how production in the economy is concentrated in certain industries.
The bank's recently been emphasizing a measure of underlying inflation, which is well below 2%, and removes some of the effects of the weak Canadian dollar, which is seen as temporary. Yet the Fed looks at low inflation rate. They never try to remove the effects of a strong U.S. dollar from their measure. Do you think the Fed should be more concerned about underlying U.S. inflation? Or is it possible the bank is too relaxed about Canadian core inflation?
Well, of course, the Fed's in the opposite situation from us, right? Because they
they're faced with a stronger U.S. dollar, which then is something that's pushing inflation down. I mean, for us, it's the weaker Canadian dollar, the flip side of that, which is pushing our inflation up. I mean, obviously, in the U.S., it is one of the factors that's moving down that's pushing down their headline inflation number, and certainly, I think when they're looking at that, they're considering, as we are, what's the appropriate policy response to that. I guess the one thing I should emphasize here is that looking through the effect of the exchange rate on inflation, in our judgment, is the right thing to do under the current circumstances because of the particular factors that are driving inflation or that are driving the Canadian dollar. But it wouldn't always be the right response, and that's why we don't actually publish a measure. We don't sort of do a formal publication of a measure that takes out the effect of the exchange rate. We present it as our judgment because it is basically our judgment of what rate is relevant to monetary policy at a particular time.
Can you provide any more insight on the potential policy choices with rates closer to the lower band, like approaching zero?
Okay, that's sort of the question that I just had, but I mean, certainly, maybe just to elaborate a little what I said earlier, I mean, looking at the experience of different countries that have done QE and tried other things, I mean, our assessment is that these policies do work, that they do actually deliver some additional stimulus. But of course, the magnitude of their effects and the amount that has to be delivered is something that's quite uncertain and may also depend on the state of financial markets. I mean, we have some circumstances where markets are really not functioning that well, and where QE and various credit market measures might turn out to be highly effective. Others where it's still effective, but it's not. It doesn't have as large an impact. So it's certainly, I'd say the jury is certainly not out on how these measures, the jury is still out on how these measures how these measures take effect and the relative merits of the different ones. But basically, I think the evidence suggests that there are a range of options that could be considered.
On inflation targeting specifically, why doesn't the bank distinguish more between good and bad deflation in targeting? It's not clear why the bank would not want to lean against good deflation driven by the technology and productivity. Is the bank planning to address this perceived shortcoming in the mandate?
Yeah, so you're referring to good inflation being inflation that might be driven by, for example, more competition in the retail sector or some other things that actually, and that's good inflation in the sense that it's actually, it's not a reflection of economic weakness, it's a reflection of actually something that's beneficial for all Canadians. And I mean, generally, I think that for us, I mean, we have our target, and for us, the big question is how persistent the trend in inflation is. So if we had improvements in retailing technology, for example, that we're bringing down measured inflation for a brief period, we would look through that in targeting inflation, because by the time that our policies kicked in, we would end up reacting to something we would already have passed. And on the other hand, if it's something that creates a longer-term trend downwards in inflation, then that would be something we would react to under our current mandate. So it really depends not so much on the nature of it, whether it's good or bad, but it depends on how long it's expected to persist.
Yeah, this question actually would refer to your days when you were at the IMF.
Yeah.
So having a single digit inflation rate, this person is unattainable. What do you think the African continent should do to achieve a single-digit inflation rate?
I mean, that is quite a long topic, but I mean, certainly, I have to say that in many, I mean, Canada is obviously very fortunate that we have a lot of elements of stability in our economy. We have we have a relatively stable and diversified real economy. We have a sound set of public finances, and we have both sound and relatively sophisticated financial institutions. And I think in countries where those things are lacking, the inflationary process is a much more complex one, and it's often rooted in some combination of financial weakness and weakness in the public finances. And so that's obviously a very different set of issues than we face here in Canada.
Okay, thank you. That concludes the questions. Henry?
Okay.
Deputy Governor Lane, on behalf of the CFA Society of Atlantic Canada, I'd like to thank you for coming to Halifax and presenting to our group today. And as a token of our appreciation, we will be making a donation to a charity chosen by Deputy Governor Lane. And thank you all for coming out today to hear this presentation. I hope you've all enjoyed it. There's been lots of information shared here, and hopefully you've garnered a lot more information on inflation targeting and the ingredients behind it. So thank you again for coming out, and enjoy the rest of your afternoon. And just one last note, Mr. Lane will be here for a few more minutes after the presentation. If you have any comments or questions for him, that would be great. Thanks again.